Hi friends, welcome back to my YouTube channel. I am CA Pritish Burton, and in this video we are going to talk about a topic which is in continuation of the previous one, that is mutual fund for beginners. If you are a mutual fund investor, then you ought to stay till the end of this video because I am going to give you an input which is very important when you invest in mutual funds. So stay tuned and let us begin. The topic that we are going to talk is direct mutual funds. Now you would ask me, what is direct mutual fund and indirect mutual fund? So let me keep it very simple. Direct mutual fund means, let me give you an example in the layman's language. Instead of buying biscuits from a shop nearby your house, you directly go to the manufacturer and you buy some packets of biscuits. Now what is the plus point here? You eliminate the wholesaler and the retailer and you get packets of biscuits for a price lesser than what you would have got from a shop nearby your house. Now, who is the manufacturer here? In mutual funds, it is the asset management company. Direct mutual funds are the ones which are offered directly by the AMC or the asset management company to you and me, that is the retail investors. Now when it comes to mutual fund agents or advisors, financial planners, they don't sell direct mutual funds. Of course they wouldn't, because they wouldn't get any commission. There is no middleman at all. There is no commission agent. It is you and the AMC. Now let us look into a bit of history in case of direct mutual funds. Direct mutual funds were first introduced in the year 2013 by SEBI, that is Securities and Exchange Board of India. So in the year 2013, SEBI thought that yes, now the Indians or the retail investors are quite equipped with the financial literacy to invest in mutual funds directly without the help of anybody else. So we had attained the financial literacy according to SEBI in the year 2013, that is you and me, the general public. Now the next question is, how do you differentiate a regular mutual fund and a direct mutual fund? There are so many funds sold in the market today. Every time you log into a particular website, you switch on a TV, you get so many advertisements of mutual funds. So how do you differentiate a direct mutual fund and a regular one? It is very simple. Every mutual fund that has a term called or a word called direct in its name. For example, ICICI Prudential Mutual Fund, direct. HDFC Mutual Fund, direct. Axis Mutual Fund, direct. So this is how you identify direct mutual funds. Now what are the benefits or the advantages of opting for a direct mutual fund? The first one is very simple, which we have already covered. That is, there is no intermediary, no agent. It is the asset management company and you. So of course there is no conflict of interest. The agent or the advisor can suggest you or advise you on investing in a particular mutual fund depending on higher commission that he gets. Here you are solely responsible for your investments and nobody else. So make the right decision, choose the right fund and then invest to the direct mutual fund. Now let us say that you walk into a bank and the bank manager asks you to invest in a particular mutual fund because he sees huge money lying in your bank account, and that is why he asks you to invest in a particular mutual fund, because the banking business is no longer purely banking today. There are so many other functions that they perform or the products that they sell. One is mutual fund. So in this case, the bank sells the mutual funds to you and you buy them. So here bank is actually not selling the direct mutual funds. Bank is selling the regular mutual fund. Bank is the intermediary or the agent which gets commission for selling the mutual funds to you. So do not get confused with that. The next advantage is that lesser expense ratio. In the first video we have discussed what is an expense ratio. So since there is no agent, no commission, your expense ratio in the mutual fund would also come down. And what is the result? Higher return or higher NAV. So higher return and higher NAV. How much more would you earn is the next question. The answer is, in the long term, you would earn 1% more. So now you would laugh at me saying that what is big deal when it comes to 1%? Does that really matter? But let us look at this chart. Let us assume that you are 30 years old and you plan to invest in a direct mutual fund for the next 25 years. You invest 5 lakh lump sum, that is upfront right now, and you invest 10,000 on a monthly basis for the next 25 years. This chart gives you a clear-cut idea as to how much more you earn when it comes to regular mutual fund and a direct mutual fund. In case of regular mutual fund, you would have earned only 1.6 crores, whereas in case of direct mutual funds, you earn 1.26 crores. That is almost about 20 lakh rupees more. Here we have assumed 8% growth, which is reasonable in the given circumstances. So this is where your 1% really matters. Now the next point is about the taxability. As I've told that I will be giving you insights in all my videos relating to investments on taxation. So here there is no difference between a regular mutual fund and a direct mutual fund. The taxability remains the same, and please refer my previous video for taxability in case of mutual funds. How do you invest in a direct mutual fund? You can invest in the direct mutual fund just the way you are investing in a regular mutual fund, either online or offline mode. Both options are available. So friends, I hope that you enjoyed watching this video and you are in a much better position in investing in mutual funds than what you were before watching this video. So happy investing, and stay tuned for more videos on personal finance and many more interesting topics. Thanks for watching. Happy investing.